Car buying has never been more complicated or literally more expensive, and the average price of a new car has climbed to nearly $49,000 compared to just $34,000 a decade ago, and that's according to Kelley Blue Book. That kind of sticker shock leaves many buyers asking, how can I possibly afford a new car? Well, dealers are quick to provide the answer. The 84-month car loan, the answer to all. Now, it sounds simple at first, but it's actually a trap. Spread across 7 years, the monthly payments shrink to a number that feels manageable to most people. A $50,000 vehicle suddenly seems affordable when the cost is sliced into little smaller segments. But is that really a smart solution, or does it carry consequences that can trap buyers in years of financial frustration? The rise of the 84-month loan is no accident. Dealerships benefit enormously from pushing buyers into longer finance terms, and smaller monthly payments make it easier for salespeople to convince customers to move up to pricier trims, tack on some additional packages, or select luxury features that would otherwise be out of your reach. For the financing office, that's where they make their money, they're stretching out the term, which makes it easier to close the deal. With the so-called payment shoppers, for those who only focus on whether they can afford the monthly payment, but not the total cost of the vehicle, this is where the trap starts. In addition to a lower monthly car payment, which improves the buyer's debt-to-income ratio, this helps more customers qualify for loans they might not be able to secure under the traditional 36-month loan terms. Before we dive in, I want to remind you to like this video and to subscribe to this channel to keep up with what's going on in the automotive world. And here's a quick word from this video's sponsor. Would you believe me if I told you inside your pantry right now is one of the healthiest foods on the planet? Yep, it's true. It's not some weird, trendy superfood. Spoiler alert, it's olive oil. According to Dr. Stephen Gundry, a famous cardiothoracic surgeon, nutrition expert, and health advocate, you should get as much high-quality olive oil in your daily routine as possible, whether you drink a shot of it daily or you use it on your food. So how can you tell the difference between an olive oil that can boost your health and one that isn't up to par? In an effort to answer that question, Dr. Gundry has released his personal research and findings. This video has gone viral since its release, and it's important for you to see if you can start benefiting immediately. You can watch the video right now by going to getolive1.com/car or by clicking the link in the description below. People who have taken his advice have shared the results with him, saying the olive oil they bought has helped change their lives. Make sure you go to getolive1.com/car and click the link in the description below for his video. On the surface, this seems like a win-win arrangement. The buyer gets the car they want at a payment they can afford, where the dealer locks in a bigger sale. But what feels like an opportunity on day one quickly becomes a burden as the true cost of the loan takes shape. And in the end, you will pay a much bigger price. Why is that? Well, the most obvious issue is interest you pay. When a car loan stretches across 7 years, there are far more months for interest charges to accumulate. Only the finance company wins here. Consider a buyer who finances a $40,000 new car at 7% interest for a traditional 60-month loan. That's the normal time frame. They'll pay roughly $7,500 in interest. With an 84-month loan, that interest expense number climbs to more than $10,700. In other words, the buyer pays over $3,000 more for the privilege of lowering their monthly bill. For most households, that's a costly trade-off, and higher interest rates themselves don't remain equal. Lenders know that a 7-year loan carries more risk than a 5-year loan, so the rate is higher. Over that long period, economic conditions could change, inflation could rise, or the borrower's financial situation could deteriorate. Anyone can lose a job or change jobs or move, and there's a lot of factors involved in life. To protect themselves, banks and credit unions often attach higher rates to longer loans. That means buyers aren't just paying interest for more years, they're paying higher interest rates, and the only one that makes out is the financial institution. The financial pitfalls don't stop there. Vehicles are depreciating assets, so the moment you take a new car off the dealer lot, it loses about 20% in value. With the first year, that loss can climb up to 30%. With long-term loans, the first several years of payments go mostly toward interest, with very little progress made on the loan principal. So you're just paying the bank to use the vehicle. The result is what's known as negative equity, or being upside down. For years, the buyer will owe more than the vehicle is worth. If they try to sell or trade the car, they'll need to pay the bank just to get out of the loan. And this forces you to keep the vehicle longer or take a big financial penalty. And then they always say they'll roll it into the next loan. You don't want to do that because you'll be upside down forever. This problem is compounded by warranties. Most new vehicles come with a bumper-to-bumper warranty that lasts about 3 years or 36,000 miles, and powertrain warranties that are typically extend to 5 years or 60,000 miles. Those timelines don't come close to the covered 7-year loan. I know there are a few exceptions with Hyundai and Kia and Genesis, but that means that a buyer is still making monthly payments and they could face transmission or an engine failure with no warranty protection. And they'd be paying for that expense out of their pocket. And that can be expensive, especially if you can barely afford to make the loan payment. They would be paying for expensive repairs on top of paying down the car itself. A double hit that could wreck household budgets. And those extended warranty companies are never worth the money either, which would increase your monthly payment as well on top of the car payment. And that would make things even more expensive. With prices rising for both new and used vehicles, long-term loans are more than just a temptation. They are, for many families, the only way to fit a car payment into their monthly budget. But while the appeal is easy to see, the long-term risks are just as clear. Stretching a loan to 7 years often leaves buyers paying thousands of dollars more in interest, trapped in negative equity and financial vulnerability. And if the circumstances change, that could be a problem. In the event of a job loss, medical bills, or unexpected expenses, they may be stuck with a car they can't afford to keep and they can't afford to sell, and you certainly don't want it repossessed. This doesn't mean long-term loans are never justified. There are a few situations where they can make sense. Some automakers are offering 0% financing for qualified buyers, which eliminates the concern for over-accruing interest. Others may find themselves in a fixed budget where the choice is either a longer loan or no car at all. And in cases where a buyer plans to keep a reliable, high-quality vehicle for a decade or more, the extra interest paid over time may balance out for the long run. You have to be honest and consider the true costs. And if you're unsure, talk to your accountant. Still, for the majority of consumers, financial experts consistently recommend avoiding that 84-month loan. The smarter move is to aim for 48 to 60-month loan terms, which not only save on interest, but also keep buyers closer to a car's actual value throughout the life of the loan. Car shoppers should also consider more affordable vehicles, make larger down payments, or explore certified pre-owned options to keep their finances in check. Cars may be getting more expensive, but debt traps don't have to be part of the deal. Buyers who look beyond the monthly payment and focus instead on the total cost of ownership will be far better positioned to protect both their wallets and their peace of mind. The finance manager at any dealer is going to try to close the sale. That's their job. You have to make the smart decision and not get trapped into those long-term loans. If you like this video, give it a like and subscribe for more videos like this, and check out our car review channel, Car Smarts. You can support me by buying me a cup of coffee, and if you want even more content, check out the links in the description. I'm Lauren Fix. Thank you so much for watching.